last year. Meanwhile, core inflation, which is the measure that excludes food, alcohol, tobacco and energy, dropped from 7.1% to 6.9%. Stocks have risen on the news while the pound has fallen, with the markets now pricing in a lower interest rate rise from the Bank of England next month than was previously expected. Well, joining me now to talk about this is Simon Wells. He's Chief European Economist at HSBC. Simon, morning to you. Lots for the Bank of England and the Treasury to be pleased about here.
Absolutely. Not only was it the first time in 5 months that we'd actually seen inflation come in lower than expected, it was actually pretty broad-based across categories. So you rightly identify petrol as being a big driver. Quite a bit of progress on food prices as well. But everything really was a little bit lower than expected. That's good news. The Bank of England will be breathing a sigh of relief, and I think everyone will be breathing a sigh of relief.
I mean, really interestingly, services inflation, big drop there. I mean, the government's obviously been very anxious about domestically generated inflation. I mean, this is a really standout feature of the day's numbers, isn't it?
That's right. And the reason everyone's focused on the domestically driven inflation is because that's the bit that interest rates can do something about. They can't do anything about the oil price in the near term. So, yes, a bit of progress on services inflation. I would caution, though, by saying services inflation is still high. And, of course, if you're a services company, the majority of your cost input is labour. And we're still seeing wage growth really pretty high at 7.3%. That's too uncomfortably high for the Bank of England. So, yes, while we should be happy that we're taking steps in the right direction, we should be realistic that costs for many firms, particularly on labour, are still rising, and they might have to pass those costs on to consumers, meaning it takes a while before inflation gets back to the levels we were used to seeing over the past 10 years or so.
Now, Simon, we have seen in other countries around the world a reminder in recent weeks, notably Australia, but also the United States, inflation doesn't always fall in a straight line. I mean, it's not guaranteed that it's going to carry on dropping from here, is it?
I think in terms of headline inflation, it's probably going to drop quite a bit next month, because recall the way that Ofgem, the energy regulator, implements price changes means in July we should start seeing drops in our energy bills in the UK, thanks to the fall in wholesale prices on global markets. So the headline number should fall again pretty sharply next month. But where I think you're absolutely right is on that core number, stripping out the energy effect. That may well stay elevated. And indeed, if we see a very strong tourism season, for example, in Europe, we are expecting that to rise back up a little bit. So it may not be all the way down in terms of core underlying pressures, but I think these energy effects means headline we should continue to fall through the summer.
So, Simon, what are the implications here for the Monetary Policy Committee? I mean, the market was pricing in a half-point rise on the 3rd of August. It feels it's going to be a quarter point, probably.
I think there's definitely that risk. I think the decision will probably be quite finely balanced, actually. The Bank of England has been caught by false dawns before. It thought inflation was easing earlier in the year, only for it to rise back again. So the money markets, as of a few minutes ago, I think were pricing in somewhere almost halfway between a quarter point rise and a half point rise at the next decision on the 3rd of August. But I mean, if we were to rewind a couple of weeks, markets were pricing in a peak rate of 6.5%. And now we're looking at something quite a bit below 6%. So that, I think, underlines the extent of that sigh of relief that markets and the Bank of England is feeling today.
And Simon, a quick word, if you would, please, on sterling. Obviously, it's been trading at a 15-month high against the dollar. It sold off this morning. Where does the pound go from here, do you feel?
Well, I think underlying the story is still a relatively good one for sterling. I mean, yes, we've seen it come off a little bit today on the interest rate expectations and the inflation news, and I think that's to be expected. But I don't think what we're now about to do is price in loads of interest rate cuts, unfortunately, for mortgage holders. And I think that limits the amount that sterling can fall. So, yes, it's been a day where the currency markets have reacted in line with the interest rate markets, which they haven't done consistently recently. But yeah, as regards sterling in the near term, I think there's still a good structural story underpinning it. All right, Simon, we have to leave it there. Appreciate you joining me today. Thank you. Pleasure.
Now, domestic bills have been a big driver of rising inflation. Apart from council tax and gas and electricity, and leaving aside mortgages, of course, car insurance is now the most expensive bill paid by most British households. Motor insurance has risen by 18% on average during the last 3 months, taking the price of the average premium to £776 per year. Well, joining me now is Steve Dukes. He's Chief Executive of the comparison service Confused.com. Steve, good to see you this morning. Why the rise in premiums?
Well, it's a huge rise, isn't it? And although some will be saying that the drop in inflation is good news, and I can see why some people would think that, will be no comfort at all to motorists who are seeing new policy prices up almost 40% year on year, which for the average policy is a couple of £100, and it's come at the worst time. There's a few reasons for that. One of the main ones is that insurers' costs, and particularly their cost of claims, has gone up quite significantly. There's two drivers of that. The first is the number of claims. During the pandemic, we went through a period of not much driving at all. Since then, people have started driving a lot more, and we see more incidents. The other piece is the value of those claims, the cost of those claims. And there's been inflation in replacement parts. Second-hand cars have held their value more, and overall insurers' costs are going up. That's the explanation, but as I say, cold comfort for drivers.
Well, it's interesting. I mean, earlier this year we had a shock profits warning from Direct Line, who clearly had been caught out by the extent to which claims inflation was rising. Is this now insurers getting wise to that and passing on those costs more rapidly?
Insurers are certainly looking to pass those costs on. What we are seeing, and it's some good news for drivers, is that in some cases, insurers have been able to find ways to be more competitive, whether that's through use of technology or other things. They are able to offer a more competitive price. And those that are picking up a lot of new customers. At Confused.com, we're seeing an increased number of searches from drivers looking to save money. That's up about a third year on year. So those insurers that have found ways to offer better prices are acquiring new customers.
Are prices rising evenly across the country, or are there geographic disparities?
In terms of the absolute rise, there really is quite a significant disparity between regions. In particular, heavily populated areas like London, Merseyside, Manchester will be seeing the biggest rises in pound terms, whereas, for example, if you're in the southwest, where they are generally less busy, there will be lower incidence, lower risk, and therefore lower increases in premiums.
Are you seeing consumers trying to save money by, for example, opting for third-party cover instead of going fully comp?
So one of the things that we've seen deliver the biggest savings for customers is particularly in the young driver segment. If they are able to share the cost of motoring and share a car with someone with more experience, that can have a really significant impact on their premium. They are sharing the vehicle with someone with more experience and then bringing down the overall premium for that cover. That's one of the ways that customers can save.
You mentioned the fact that replacement costs are higher. Is that down to car pricing? I mean, we've obviously seen elevated prices for second-hand cars over the last 18 months.
Absolutely right. The second-hand car value is elevated, but also replacement parts due to underlying inflation are more expensive than they used to be. And even the cost of those repairs, the cost of labour in garages, is up significantly too. So taking those three things together does explain some of the rises, but as I said, that would be no comfort for drivers who are looking to save money in any way they can right now.
We've obviously had regulatory changes to try and stop insurers from treating existing customers differently from new customers. Is that having an impact?
It's changing things, and I think the spirit of those regulations came from exactly the right place. What customers are finding, though, is the only way to know that they are really getting the best deal is to look around, and they can't rely on their current insurer always giving them the best price. So if you're one of the very few customers that has seen a cheaper renewal year on year, and that's only 1 in 10 customers that we surveyed, even those often will find a better price out there. So I think customers are relying on the fact that their existing habits tend to get them the best price.
All right, Steve, we have to leave it there, I'm afraid. Good to talk to you today. Thank you. Some other business news stories now, and staying with motoring, the owner of Jaguar Land Rover has unveiled plans to build an electric car battery factory in the United Kingdom. Tata Motors says it's planning to invest more than £4 billion after months of talks with the government over taxpayers' subsidies to fend off reported competition for the investment from Spain. But according to Tata Group, this will be one of the largest ever investments in the UK automotive sector, and the gigafactory will deliver half of the battery production needed by 2030. National Grid said this morning it is selling a further 20% stake in National Gas, its UK gas transmission and metering business. The £700 million sale to a consortium of long-term infrastructure investors led by Macquarie Asset Management comes after the company sold a 60% stake to the same buyer for £2.2 billion in January this year. National Grid said the sale was part of its strategy to pivot towards electricity, and it follows the company's acquisition of Western Power Distribution for £7.8 billion 2 years ago. The shares are ahead nearly 2% on the news. And shares of Hargreaves Lansdown rose by more than 7% this morning after the UK's biggest retail investment platform reported better than expected trading during the final 3 months of its financial year. The Bristol-based company said it enjoyed net new business of £1.7 billion during the 3 months to the end of June. That was up 6% on the 3 months to the end of March. Hargreaves Lansdown said this was in no small part due to clients using their ISA and SIP tax allowances during the final days of the 2023 tax year and the start of the 2024 tax year. The company put on 13,000 net new clients during the period, taking it to a total of just over 1.8 million. Well, as I mentioned earlier on this morning, the pound has fallen sharply on the foreign exchange markets after that softer than expected inflation data. The markets are now pricing in a lower peak for interest rates than previously thought. Sterling off 0.4% right now against the US dollar, nearly 0.75% against the euro. On the equity market, stocks in the Asia-Pacific region enjoyed a largely positive session overnight following further gains on Wall Street last night. The Nikkei in Japan hit another 2-week high. In Europe, meanwhile, stocks are all in positive territory this morning. That's the picture right now in continental Europe. Not much in it, to be honest, but the MIB in Milan, for example, more or less unchanged there. Talking points in continental Europe this morning include Kering. The French luxury goods company is up 6.25% in Paris after the appointment of a new chief executive of Gucci that was well received by investors. Here in London, the FTSE 100, as I mentioned earlier, up very, very strongly on that inflation number, ahead by more than 1.5% right now in a broad-based rally led by the house builders. Have a look at some of these prices. They're absolutely sensational. Persimmon, Barratt, Taylor Wimpey, all ahead by more than 5%. They were up again last night as well, by the way. Some of these were up 7 or 8% earlier on, so they've given back some of their earlier gains from the open. Elsewhere in the commercial property sector, Segro and Land Securities also cheered by hopes that interest rates may not now hit the peak previously expected. Landsec's up nearly 6.5% there. Not too many fallers to mention, but the Chilean copper miner Antofagasta is off by 2.5% on a production update. Outside the FTSE 100, well, again, the house builders are leading the way. Bellway up by 5.5%, Crest Nicholson up by nearly 8%. As for the oil price, well, that is ahead today on news of an expected drop in US crude inventories. Barrel of Brent crude will currently set you back $79.95 a barrel. That is up 0.2% on the session. Joining me now, Rachel Winter, partner at Killick & Co. Rachel, good to see you this morning. Really very exciting morning for equities on the inflation data.
Yeah, such a relief. I mean, last month, I think we were quite concerned that inflation was stuck at 8.7%. So great to see such a big decrease this morning. And as you say, great news for the property sector. So this means lower interest rates, lower mortgage rates. That means mortgages become more affordable, and that's going to push up the prices of house builders, as we're seeing today. Same for commercial property companies as well. So real estate investment trusts here in the UK. Some of those have a lot of debt. So if interest rates are going to hopefully not go up by so much, that's good news for them, and we're seeing big gains there this morning as well.
Yeah, the snapback in some of these house builders, and they were ahead last night as well, kind of suggests there was probably quite a lot of short interest out there in the market.
It does. I mean, some of these house builders have come off 50% over the last year, so I think there are some quite big losses that some people have had. Not surprising, therefore, to see some people buying back in on the good news this morning.
Well, away from home, Rio Tinto, obviously one of the big FTSE miners, production update this morning not being terribly well received?
No, so with the miners, we tend to look at copper production because this is really important for decarbonisation and electrification. And to give you an example, a petrol vehicle needs 25 kilos of copper, whereas an electric vehicle needs 75. So if we're all going to start driving electric vehicles, that's going to lead to a big demand for copper. So we're all looking at this. But in Rio's numbers this morning, there was a bit of a decline in their guidance for copper production. So a bit disappointing, but they are still planning to triple their copper production over the next decade.
Which is quite extraordinary given the sheer size and scale of these businesses.
Absolutely. Rio Tinto is worth billions. At the moment, copper makes up about 10% of their revenue. So to triple that really is quite a big undertaking.
Now, another feature in the FTSE today, Hargreaves Lansdown, not terribly, there's not been terribly large amounts of good news from this company of late, but this morning there was.
Yeah, so the assets under management were up quite a bit more than expected, and that will have been helped by the strong market performance we've seen over the last few months. Market's clearly very happy with the update this morning because the shares are up so much higher. We did see a reiteration of a buy note from Invesco this morning after the results came out, and that has helped to push the shares higher still. But reading between the lines of the update, there were some cautious comments in there. So there were some comments about how some clients aren't trading as much because they're nervous about markets, and some clients have been taking money out of Hargreaves and putting it back into cash accounts where they can get a higher interest rate.
Yeah, and we've heard a lot of talk about that around the market, people taking money out of equity funds and putting into these cash accounts.
Yes, cash accounts, and also some people are taking out money from equities in order to pay off mortgages. So that has caused a bit of weakness for some fund managers.
All right, Rachel, always good to see you. Thanks for joining me today. Still to come here on Business Live, why Chivas Brothers is going to share details of its new green production methods with its biggest whisky rivals. Don't go away.
I'm Mark Stone and I'm Sky's correspondent based here in Washington, D.C.
Well, the plan seems to be to head to the police station where the policeman who fired the shots was based.
And everything, his memories is all gone.
I've witnessed the remarkable passion for politics here, but the anger too.
We have to get Trump out of the White House.
I'm playing devil's advocate.
You got your political agenda.
No, it's honestly...
God love you.
And beyond the United States, I report from around the world.
This is a town that is effectively encircled by the Russians.
We take you to the heart of stories that shape our planet.
I can hear now quite a few explosions in the distance here in Jerusalem.
What do you think of ISIS?
Everybody here, they know the truth of ISIS.
The five of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
It's like Emirates. It's like better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, when businesses come up with a neat idea or innovation, they usually want to keep it to themselves, which is why it's all the more unusual that Chivas Brothers, the world's second largest Scotch whisky producer, wants to share its latest innovation. The company, whose brands include the Glenlivet, Albalaw, Ballantine's and Chivas Regal, is making its carbon-cutting heat recovery technology, which claims to have halved energy consumption during the whisky distillation process, open source. Well, joining me now to talk about this is the Chairman and Chief Executive of Chivas Brothers, Jean-Etienne Gorge. Good to see you this morning, sir. Without getting too technical on me, how does the process work?
Well, the process is actually pretty simple. We naturally produce steam and vapor in the distillation of whiskey. So it's a way to capture this steam and to reuse it in a very efficient way. So we are compressing it several times so that it can almost be like a closed loop. And by doing that, we can heavily reduce the need of energy and therefore cut the carbon emission.
And I think you've more than halved your energy consumption. How much has this saved you financially?
Well, it would be a return on investment because you need to have an investment up front. But just to give you a simple figure, before you could have for 1 unit of electricity, 1 unit of heat. With this system, we can have for 1 unit of electricity, 12 units of heat. So it's really a very strong ROI, return on investment, especially in a moment where the energy cost is so volatile.
This is probably a very silly question, but I'll try it anyway. Does it affect the flavour of the whisky at all?
No, it doesn't at all. That's that's the first question mark that we had, and that's a lot of pressure has been put on the team to make sure that it doesn't change when we do blind tasting the flavour of the whiskey, but it's all good. But it was one of the complexity of that.
Very reassuring to hear that. Now, you're making this open source, this technology. Why?
Well, I think, it's an act of generosity, which is normally quite unusual in business, but it's not that unusual in the Scotch whisky industry. I mean, long story short, we are all racing for net zero. And I think that we cannot win this race alone. So on this one, we have pioneered a technology. We are opening that to our peers. And we hope that as well, they may do the same for other topics, and that together we can win quicker the race to be at net zero as soon as possible.
And were there implementation costs involved for you?
Yes, I think the biggest implementation cost, to be honest, is that we need to shut down the distillery so that the cost of not producing. So there's an element of bold decision, but as I think what is groundbreaking is how to reduce this time as much as possible so that we can operate in a much greener way afterwards.
And more broadly, when do you expect to start achieving net zero targets?
So we have a commitment in terms of distillation to achieve it by the end of 2026, which is no less than 2.5 years. So I can tell you every week matters to be able to reach this objective.
And do management bonuses depend on this? Are you hitting that target?
Yeah, that's a reality, yes. And it's but most important than the management bonus, I think the consumer bonus depend on that. So our credibility toward our consumer.
And how are you trading right now? How is the Scotch whisky category performing for you?
Well, all in all, the Scotch whisky has been performing pretty well. Last calendar year, 2022, was a record high year for the Scotch whisky industry. Our sale we posted for the first 6 months at plus 23% in terms of growth in the business, so which is placing us, well ahead compared to pre-COVID time. And the beauty, I think, of the Scotch whisky industry is that it is very well balanced between the geographies, between Americas, between Africa, Europe, Southeast Asia, and China. So it's a very aged industry with a lot of consumers around the world, and we are very, very confident for the future.
Obviously, there's a big debate going on in the UK right now about the fact that the government has taken away VAT-free shopping for tourists. Presumably, you'd be all in favour of that being restored.
Well, I think it's an opportunity for the travellers to test and to experiment. Travel retail is a great place for that. So you may try something different than what you purchase usually, and it's cost efficient. So yes, the date will come back. I think everybody will be happy, including myself when I'm back in the UK.
And how about the Glenlivet in particular? You're doing a lot of different variations on it, for example, in old rum barrels and flavouring it accordingly.
Yeah, I think that, there is a great appetite in whiskey consumers in trying new things. So it may mean as well to try new tastes. and the going into oak barrels. Sherry barrel is a well-known type of natural flavoring, but the rum one is very interesting. It gives a lot of sweetness and warmness, and it's good as it is, as it is. It's excellent as well in with sparkling water in long cocktail, and it's a very refreshing drink for the summer.
Very good. Jean-Etienne, pleasure to speak to you today. Thank you. That's it from me. I'm back at 4:30 this afternoon. Sally Rockwood's up next. Stay tuned.